Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Zoetis.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So, imagine you're walking into like a really high-end luxury car dealership.
Okay, I'm picturing it.
Right, and you point at their absolute best flagship vehicle. But then you find out it's suddenly on sale for 20% off.
Which never happens.
Exactly, never happens. And it's not because the engine is blown, but just because, I don't know, someone put a scratch on the bumper and management completely panicked.
That's a great analogy.
Yeah, and that is exactly the scenario we're unpacking today. We are looking at Zoetis.
The undisputed world leader in the animal health space.
The absolute gold standard, honestly.
Yeah.
But recently, it just suffered this earthquake of a single-day crash.
Yeah, plummeting 20%.
20% to a 7-year low, which for a company of this size, this scale, a 20% haircut in a matter of hours is just staggering.
It's massive. It really forces you to ask some uncomfortable questions as an investor.
Right, because you have to wonder, is investing in Zoetis right now like buying a house with a cracked foundation that's, ready to collapse?
Or is it just a premium house with a leaky roof during a bad macroeconomic storm?
Exactly. One requires a complete teardown, and the other just, well, needs the weather to clear. And I have to admit, I tend to lean cautious here.
Which makes sense.
Because a drop that violent usually means the market is pricing in something structurally terrifying.
It's entirely understandable to feel that caution, when you log into your brokerage account and just see this absolute sea of red.
Yeah, it hurt.
It does. But what's fascinating here, and really the entire mission of our analysis today, is separating that cyclical weather from actual structural damage.
So looking past the immediate panic.
Exactly. The market is a highly emotional machine in the short term. But our goal is to figure out if it's severely overreacted to temporary headwinds.
All right, let's move into the wealth building context, because
Yeah.
you're essentially saying we need to, ignore the noise.
We do. If you connect this to the bigger picture of your portfolio, you have to remember that true wealth building isn't about frantic short-term trading based on yesterday's headlines.
Right, it's not day trading.
No, it's about identifying and acquiring what we call premium compounders and doing it at deep value discounts.
Okay, define a premium compounder for the listener.
So a premium compounder is a business with such a dominant market position and such a strong financial foundation that it consistently grows its intrinsic value year after year.
Like clockwork.
Like clockwork. But to evaluate one properly, you can't just look at a 3-month window. You need to zoom out.
Zoom out how far?
You really need to look at a 12 to 24-month horizon.
And that time horizon is crucial here, right? Because the entire thesis rests on the whole pet economy.
Exactly, the humanization of pets.
Yeah, over the last decade, there's been this massive premiumization trend. People treat their animals like human children now.
They absolutely do.
They aren't just buying, cheap kibble anymore. They're buying specialized diets, orthopedic beds, and high-end preventative health care.
So true.
So you're saying we need to give the market a year or two to let that premiumization trend normalize after these recent inflation shocks.
Precisely. Because the humanization of pets is a secular megatrend.
It's not a fad.
No, it's a fundamental shift in human behavior. And that doesn't just disappear because inflation ticked up for a few quarters.
Right. People will cancel their own vacations before they cancel their dog's surgery.
Exactly. They'll cut back on dining out, but they will pay for that necessary treatment. So by extending our view to that 12 to 24-month window, we let the temporary macroeconomic dust settle.
We give the thesis time to play out.
Yes, and we allow their new pipeline of blockbuster drugs to actually hit the market and show up on the balance sheet.
Okay, and I have to play devil's advocate here, how does that philosophical approach actually hold up when we look at the hard numbers?
Let's get into the numbers.
Now let's look at the fundamentals, because I have to be honest, looking at the Q1 2026 earnings, there is some genuinely bad news to sift through.
There is. There's no denying that.
This is where my skepticism kicks into overdrive. The U.S. companion animal revenue, which is their absolute crown jewel, their growth engine, it dropped by 11%.
Yeah, 11%.
11%. That is not a rounding error. that is driven by real, undeniable macroeconomic price sensitivity. People are feeling the pinch and they're pushing back on vet bills.
They definitely are.
Plus, you have generic competition aggressively eating into older legacy drugs, stuff like Convenia and Cerenia. And usually when generics enter the arena, premium margins just get slaughtered.
Right, and those are the exact pain points the market fixated on. That's what triggered the massive sell-off.
It's terrifying on paper.
They are valid concerns, but this is where it gets really interesting if you dig beneath the surface of those headline numbers. Yes, U.S. companion animal revenue took a serious hit.
A huge hit.
But if you look at the total global picture, total Q1 revenue actually grew by 3%.
Right, really.
Yeah, it reached $2.262 billion, and their adjusted earnings per share actually increased by 9%.
To what?
To $1.53.
Wait, how is that mathematically possible with such a massive double-digit drop in their core U.S. segment?
Because the business is masterfully diversified. While the U.S. consumer was tightening their belt, international revenue grew by 10% organically.
Oh, wow. 10% internationally.
Yes, and their global livestock segment, that surged an impressive 12%.
Okay, so the rest of the world and the agricultural side basically acted as a giant shock absorber.
Exactly. They were firing on all cylinders while the U.S. pet side was struggling.
Okay, I have to challenge you on that livestock point, though, because agricultural margins are notoriously tight.
They usually are, yeah.
Right. Farmers are businessmen. They pinch pennies on every single input. So can a surge in livestock sales genuinely absorb a double-digit hit to their most premium U.S. pet care segment? Or is that just like a temporary Band-Aid?
It's a fantastic question, and the answer lies in the actual profitability metrics. You would think their margins would compress under that kind of pressure.
Right, shifting from high-margin pets to lower-margin cows and pigs.
Exactly. But the data tells a completely different story. Their adjusted gross margin right now is sitting at an incredible 71.8%.
71.8.
Yes. And if you exclude foreign exchange fluctuations, their margins actually improved by 140 basis points.
And just for anyone not breathing Wall Street air all day, 140 basis points is just a fancy way of saying 1.4%.
Right. Exactly. But a gross margin approaching 72% is exceptional. I mean, that is software company territory.
Yeah, you don't see that in physical manufactured products.
You really don't. It's a massive testament to their pricing power. They are demonstrating robust cost management, even when demand softens in certain areas.
Okay, I'll concede the margins are phenomenal, but I'm still stuck on the generic competition. What protects them from just being slowly eaten alive by cheaper alternatives as their patents expire?
Well, this is where we have to talk about their competitive moat. It's built on complex biology, not just chemistry.
Oh, biologics.
Exactly, biologics and monoclonal antibody therapies. We're talking about breakthrough drugs like Cytopoint and Librela.
Explain the difference for the listener. Why does biology versus chemistry matter?
So, unlike a simple chemical pill, say an aspirin, where a generic company can just copy the molecular recipe in a lab, a biologic is entirely different.
Because it's alive.
Yes, it is literally grown from living cell lines. Replicating that exact manufacturing process without violating patents is incredibly complex.
Like how complex?
Like how Cytopoint specifically targets the IL-31 protein to stop itching in dogs. Trying to replicate that is like trying to forge a masterpiece painting using a completely different set of paints and brushes and just hoping the appraiser won't notice.
That's a great way to put it.
The mechanism of action currently has no generic equivalents because it's so difficult to replicate safely and legally. And they're actively expanding this moat too.
How so?
They're in the process of acquiring Neogen's animal genomics business.
Genomics for livestock.
Yes, to supercharge their livestock genetics portfolio. Farmers pay top dollar for genetic data that tells them which cow will produce the most milk or which one will resist disease.
Right before they spend thousands feeding it.
Exactly. It's high-margin innovation. Furthermore, just look at how efficiently they use their capital. Their return on invested capital, or ROIC, is a massive 28.04%.
28%.
Wow!
To give you context, the broader market average usually hovers around like 11%.
Right, so for every dollar they reinvest into their business, they're generating 28 cents in return. They absolutely crush the broader market in capital efficiency.
And what about their debt levels? If we're stuck in a higher for longer interest rate environment, debt can become a real noose.
Their balance sheet is rock solid. Net debt to EBITDA is at a very manageable 1.65 times.
Okay, and just to translate net debt to EBITDA for you, EBITDA is essentially a company's cash profit before accounting quirks. So a ratio of 1.65 means their total debt is just over 1.5 times what they earn in a single year.
Which is very healthy.
Yeah, they could wipe out their debt incredibly fast if they had to. They are a cash-generating machine.
Exactly. They're not going to get squeezed by interest rates.
That brings us to the catalyst timeline. If we're looking ahead to the next 3 to 6 months, what is going to actually move the needle for the stock price?
Well, the most immediate event is the Q2 2026 earnings coming up in early August.
And given the bloodbath of Q1, the pressure on management has to be immense, right?
Paradoxically, the pressure is actually off. And this is a crucial psychological concept for you to understand as an investor.
How's the pressure off?
During that Q1 report, management aggressively lowered their forward guidance. They revised their 2026 adjusted earnings per share expectation down to a range of $6.85 to $7.
Okay, so they lowered the bar.
Because the bar to clear is now significantly lower. The market has already priced in this deeply pessimistic outlook.
So it's the classic corporate strategy of under-promising so you can over-deliver later.
Exactly.
You lower the hurdle so close to the ground that simply stepping over it looks like a massive victory to Wall Street.
Precisely. Any slight stabilization in U.S. vet visits or a recapture of market share in their dermatology line could result in a huge, unexpected earnings beat.
What else is on the horizon besides earnings?
You have the expected closing of that Neogen acquisition in the second half of 2026. Any updates on how they're integrating that pipeline or realizing regulatory synergies could really reinvigorate the growth narrative.
I want to zoom out for a second and ask you about the broader macroeconomic environment.
Sure.
Because right now, discretionary spending is universally tight. If we see a macro pivot this summer, say the Federal Reserve finally starts cutting interest rates, or we see a real easing of inflation, how directly does that impact a veterinary medicine company?
It is a direct one-to-one relationship.
Really? One-to-one?
Yes. The primary constraint on U.S. pet owners right now is price sensitivity. It's inflation eating into their paychecks. If you see rate cuts or cooling inflation, it immediately relieves the pressure on the consumer's wallet.
So discretionary income frees up.
Right. And that pet economy premiumization trend we talked about, it reignites instantly. People go back to the vet for preventative care. They opt for premium therapeutics instead of cheaper alternatives, and volume just recovers across the board.
Now let's pivot to the chart. We really have to talk about the technical damage here because it is visually shocking.
It's an ugly chart, no question.
We had a violent price reset. The stock dropped to a 52-week low of roughly $87.31. That is incredibly far below its 20-day moving average, which sits at $117.32. And it's nearly half of its 52-week high of $172.23.
It's a massive drop.
And the momentum indicators, like the MACD, are deeply, deeply oversold.
Yes, the technicals show a classic capitulation scenario.
For our listeners who don't spend their days staring at technical charts, SED is essentially a momentum indicator. It looks at short-term price trends versus long-term price trends. When the short-term line plummets way below the long-term line like it just did, it screams that the stock is deeply oversold and potentially due for a bounce.
Right.
But what really catches my eye is the volume data from that drop. On May 7th, 30 million shares traded hands.
Unbelievable volume.
To put that in perspective, the usual daily volume is around 4 million shares. 30 million. That feels like everyone rushing for the exits at the exact same time. Is everyone just fleeing?
Well, this raises an important question about market mechanics. When you see volume explode from 4 million to 30 million on a massive down day, it's often a hallmark of what we call a capitulation event.
Capitulation.
Yes. It is the moment of maximum pain in the market. It's the moment where the last of the weak hands, retail investors who are just holding on hope finally panic.
Stop losses are triggered, margin calls hit.
Exactly. And people just sell at any price to stop the bleeding.
It's just an emotional dumping of shares.
It is. But you have to ask yourself, who is on the other side of those 30 million shares?
Right. Every seller requires a buyer.
Exactly. Climactic selling volume like that often signals the exhaustion of a downtrend. It marks the precise moment where institutional investors, the smart money, step in.
They see the underlying value.
Yes. And they begin accumulating massive blocks of shares at rock-bottom prices. They're happily taking the inventory off the hands of panicked retail investors.
So what does market sentiment look like right now? Because if you just read the financial headlines, you'd think the company was going bankrupt tomorrow.
Oh, the narrative is a wall of negativity.
Total doom and gloom. We're seeing headlines calling it the worst S&P 500 stock of the day, with articles detailing why the quarter is actually worse than it seems.
The immediate mood is overwhelmingly bearish, there's no denying that. But this is where you, as a smart investor, have to separate the noisy, click-driven headlines from the underlying value of the asset.
What are the headlines missing?
There are highly positive undercurrents that the panic is completely ignoring. For example, while the U.S. struggled, they just received regulatory approval in Canada for their Convenia RTU product.
Oh, I hadn't seen that.
And they just successfully launched a Pokul chewable in Thailand. The global expansion is quietly marching forward, completely ignored by the mainstream financial press.
And what about the professional analysts? Are they buying into this doom narrative?
Not entirely. Before this earnings report, the consensus average price target from professional analysts was $149.69.
Compared to the post-crash price hovering around $88.
Exactly. That implies massive upside. And we're already seeing analysts from places like the Motley Fool publicly stating they are actively buying the dip.
Why are they so confident?
Because the stock is now trading at roughly 13 times forward earnings.
Let's contextualize that multiple for a second.
Okay, when you pay 13 times earnings for a premium compounder that generates a 28% return on invested capital, you're essentially buying a Ferrari at the price of a used sedan.
That is incredibly cheap.
It really is.
I also want to address some of the speculative whispers I'm hearing in the market, because there are rumors circulating about a potential long-lasting Cytopoint approval coming down the pipeline.
Yes, that's a big one.
And also next-generation chemistry diagnostics. If those hit, that completely changes the narrative overnight. And honestly, with their massive cash flow and the stock sitting at a 7-year low, couldn't they become a massive target for activist investors or even private equity?
It is highly speculative, but the logic is entirely sound. Private equity firms dream of acquiring businesses with software-like margins, incredible cash generation, and a depressed stock price due to temporary macroeconomic issues.
They could take it private, optimize operations, milk the cash flow, and then IPO it later for a massive profit.
Exactly. Whether a buyout actually happens or not, the sheer fact that the valuation makes them a logical target provides a very real floor for the stock price.
Now let's talk about the risks. We need to address the elephant in the room. Let's thoroughly explore the bear case, because I am not entirely convinced we are out of the woods yet.
That's fair. What's your biggest concern?
My biggest structural fear is this.
Yeah.
What if the drop in U.S. vet visits isn't just a temporary macroeconomic blip? What if we have actually hit a permanent ceiling on pet care affordability?
That's a grim thought.
But possible, right? Between inflation, housing costs, everything else, maybe the average family just cannot afford $300 biologic injections for their dog anymore, no matter how much they love them.
It's a real pressure point.
And alongside that, what if aggressive generic pricing permanently erodes their core legacy franchises? If volume doesn't recover, the whole growth engine stalls out.
That is the ultimate worst-case scenario. And it is a completely valid risk that you have to consider. However, the mitigation here is found in the valuation we just discussed.
Because it's already so cheap.
Right. The market has already priced in that exact doomsday scenario. By sending the stock to a 7-year low and compressing the forward price-to-earnings ratio down to that 13 to 20 range, the market has heavily discounted a prolonged, perhaps permanent downturn in those legacy products.
So you're no longer paying a premium for perfection.
Exactly. You are paying a deep discount for expected pain.
Okay, the price reflects the risk. But how is management actually fixing the problem at the ground level? They can't just wait for the economy to fix itself.
And they aren't just sitting still. To combat the generic erosion and the price sensitivity, management is aggressively deploying point-of-sale loyalty programs.
Interesting. Why point of sale?
Because it's brilliant. Instead of lowering the wholesale price and destroying the brand's prestige, they make the transaction more affordable for the consumer right at the vet's counter. It provides targeted relief.
Oh, that makes sense.
But the most important defense they have is innovation. They have a pipeline of over 12 potential blockbuster drugs currently in development.
What kind of drugs?
They are targeting massive unmet needs like chronic kidney disease and oncology in animals.
Oh, wow. Cancer treatments for dogs.
Yes. As pets live longer, they get the same old age disease as humans do, and owners are desperate for treatments. The natural life cycle of a pharmaceutical company is that old drugs eventually lose patent protection and fade, while new, highly profitable patented drugs are launched to replace them.
So that pipeline is the engine of their future growth.
Yes, and it is largely insulated from current generic pressures.
So with everything on the table, what's the final verdict?
Taking all the fundamentals, the technical capitulation, the robust pipeline, and the current valuation into account, the ultimate takeaway yields a bullish score of 7 out of 10.
7 out of 10. That reflects a strong underlying business, but heavily acknowledges the current macroeconomic friction and the generic risks.
Precisely. The long-term view here is a multi-year hold thesis.
Right.
You need to allocate a 12 to 24-month horizon.
Not a quick flip.
Definitely not. This allows the U.S. companion animal market the necessary time to normalize past these inflation shocks. Furthermore, it provides the required runway for that pipeline of 12-plus blockbuster drugs to mature, clear regulatory hurdles, and begin delivering significant value to the bottom line by late 2027 and 2028.
It really all comes back to how you view the future of pet ownership. I'll leave you with a final thought to ponder. We live in a world where demographic trends clearly show people having fewer children and increasingly treating their pets as human family members.
The emotional bond is just incredibly strong.
It really is. And the willingness to spend on their health and comfort is deeply ingrained in modern culture. In that kind of world, is betting against the long-term advancement of veterinary medicine a foolish wager? It's definitely something to think about.
Absolutely.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.